Most investors believe their edge comes from prediction. They believe if they can forecast correctly, they will outperform. They focus on being right, they focus on timing, they focus on insight. But in probabilistic systems, being right is not the primary advantage. Asymmetry is. And asymmetry is misunderstood. In simple terms, asymmetry means that the potential upside is meaningfully larger than the potential downside. It does not mean certainty. It does not mean high probability. It means favorable payoff structure. And this distinction is critical because markets are not deterministic. They are probabilistic. Even the best investors are wrong frequently. The difference is not accuracy. It is payoff distribution. Let's make this mathematical. Imagine two strategies. Strategy A wins 70% of the time, but gains only 1 unit per win and loses 3 units per loss. Strategy B wins 40% of the time, but gains 5 units per win and loses 1 unit per loss. Most people are attracted to strategy A. It feels safer, more consistent, but strategy A has negative expected value. Strategy B has positive expected value. This is the essence of asymmetry. Edge is not about frequency of being right. It is about magnitude when right relative to magnitude when wrong. This principle appears in professional trading, venture capital, and options theory. Venture capitalists expect most investments to fail, but a small number generate outsized returns. Their portfolio is designed asymmetrically, small limited losses, occasional massive wins. That payoff distribution produces long-term positive expectation. Nassim Taleb popularized the idea of convexity. Convex payoff structures benefit from volatility. Concave structures are harmed by volatility, and many investors unknowingly position themselves in concave structures. They sell upside for small premium. They use leverage for incremental gains. They chase steady returns. These approaches appear stable until variance expands. Then fragility appears. Asymmetry protects against fragility. Let's examine historical examples. Consider early-stage investment in companies like Amazon. In the early years, volatility was extreme. The probability of failure felt high, but the upside potential was enormous relative to downside. Limited capital allocated, massive potential return. That is asymmetry. Now compare that to selling volatility for small premium. High probability of small gains. Occasional catastrophic loss. This is negative asymmetry. It feels stable until it isn't. Behaviorally, humans prefer high probability outcomes. This is linked to certainty bias. People overweight probability of winning, even if payoff structure is unfavorable. Casinos rely on this bias. Gamblers prefer frequent small wins. Even if the expected value is negative, markets exploit the same instinct. Many strategies offer high win rates, but poor risk-adjusted asymmetry. And investors gravitate toward them because consistency feels safe. There's another dimension. Asymmetry requires patience. Because asymmetric opportunities are not constant. They appear episodically, they often look uncomfortable, they often require buying when uncertainty is elevated. They often require waiting long periods without activity. This is emotionally difficult because inactivity feels unproductive and buying during uncertainty feels dangerous. Howard Marks often speaks about risk asymmetry. He emphasizes that superior investing is not about finding good assets. It is about finding good assets at favorable prices. Price determines asymmetry. Even extraordinary businesses can produce poor returns if purchased without margin of safety. Benjamin Graham's concept of margin of safety is essentially asymmetry in disguise. Limiting downside, maintaining upside, reducing exposure to permanent loss. Let's connect asymmetry to drawdowns. If you construct a portfolio where downside is controlled and upside remains open, volatility becomes less threatening. Because downside is bounded. But if downside is undefined and upside is capped, volatility becomes lethal. This is why leverage without limits is dangerous. Leverage compresses downside tolerance. It destroys asymmetry. In options markets, asymmetry is explicit. Buying options has limited downside, premium paid, and potentially large upside. Selling options has limited upside, premium received, and potentially unlimited downside. The asymmetry is clear, but psychologically, investors prefer selling options because of a higher win frequency. Again, frequency is mistaken for edge. Payoff distribution is what matters. Another research-based insight relates to skewness preference. Behavioral studies show investors are attracted to positive skewness, lottery-like payoffs. But they also underestimate negative skewness in strategies that offer stable returns. The attraction to smooth returns can hide tail risk. Tail risk is asymmetry in reverse, small gains, rare but severe losses. This is how many hedge funds collapse, not from constant error. From one asymmetrical mistake, asymmetry also applies to capital allocation. If you risk 50% of your portfolio on a single idea, asymmetry disappears. Even if the expected value is positive, concentration amplifies downside. Position sizing is part of asymmetry. True asymmetry requires limited downside exposure per decision. Otherwise, probability does not matter. Now let's make this practical. To build asymmetry, first, define maximum loss per position. Second, avoid strategies with unlimited downside and capped upside. Third, seek environments where mispricing creates disproportionate upside. Fourth, wait for price dislocations. Fifth, size positions relative to downside, not conviction. Conviction is emotional. Downside is structural. Here's the uncomfortable truth. Most investors are not losing because they are wrong too often. They're losing because their payoff structure is flawed. They chase high win rates, they chase consistency, they chase smooth equity curves, but smooth curves often hide convex risk, and convex risk destroys capital abruptly. Asymmetry is the only edge that survives uncertainty, because uncertainty cannot be eliminated, prediction cannot be perfected, timing cannot be optimized consistently, but payoff structure can be designed, and design determines survival. If you remember three things from this video, first, edge is about payoff distribution, not prediction accuracy. Second, frequency of being right does not equal profitability. Third, limit downside first, upside compounds naturally. Markets do not reward those who are right most often, they reward those whose upside meaningfully exceeds their downside. That is asymmetry. And asymmetry is structural, not emotional.